I'm Teddy from Spicehaus Partners, and I'm here to speak about my top 5 investment pitfalls that you should have seen before. We invest in Swiss startups between seed stage and Series A. We screen about 500 investments every year and complete about 10 to 12 a year or 1 a month. In the last 7 months, we have completed 6 investments. The exit price for Swiss startups is about 100 million. To be exactly, the median price is 107 million Swiss francs. So we do not typically produce unicorns. Obviously everyone speaks about them, everyone loves them, but the reality is majority of exits are not unicorns. And you have to keep that in mind when you invest. If you invest at an 80 million valuation, assuming a median exit price of 100 million, you will never make a 10x. It's that simple. So what do is we calculate backwards. We say, okay, we assume this and that exit price, let's say 100 million. We invest at 50 million, assuming 2 subsequent funding rounds where you get a dilution of 20% each. And then you have an employee share program that dilutes you another 10 or 20%. And the valuation goes from 50 to 100 million. You end up not doubling your valuation, but just getting your money back. So the dilution is super strong in venture, and as you know, it always takes longer and costs more, so always factor in 1 or 2 more rounds, which then implies that calculating back from your target valuation, you pretty much see in what range you can invest that it still makes sense for you. Switzerland is not Silicon Valley. I mean, yes, we produce world-leading technology. Yes, our startups are being acquired by the Googles and the Apples of this world. But in the overall market, Switzerland don't pay too much for fantasy. So the typical companies do not burn millions over years and everyone is still happy. The Swiss market is more bottom line focused. So they look at the sort of the break-even aspect of a business. And with that in mind, a price of 100 million is much more realistic or reflective of the Swiss market than someone paying billions for a startup. I also think it's a bit the founder's spirit. We always say the Swiss are too humble, but it's simply that even if we all say we should be less humble, it's just the market is not there that you can say I start today and I'm going to be a 10 billion Swiss francs company. It's in Switzerland is already ambitious to say I'm going to reach 100 or 200 million, which I think is not a bad thing, because in general we produce quality startups and they don't need to be unicorns to be successful. We generally invest below 10 million Swiss francs. As venture capital investors, we are minority shareholders. So at the beginning there's excitement and there's conviction, and you assume this is the right thing. The shareholder agreements and all the other agreements you create in case something goes wrong or in case of a disagreement. So for example, you have a board seat, you feel that you're in power, you have control, but in a major disagreement, the majority shareholder just kicks you out and you're no longer in the board. So how do we protect ourselves? There's typically the important shareholder matters, important board matters, or even certain veto rights that give you a say in case things happen that you would never have thought. You invest 1 million, the majority shareholder controls 80% and just pays out 1 million as a dividend, taking 800,000. Of course, this is not a situation that can be expected, and I'm talking about the very rare cases, but in case such cases happen, you want to have the ability to do something. Or also the team decides to pay out 500,000 bonus each. This is not illegal after the funding round, but this is not what you would expect. So for example, agreeing a veto right on any expenses over 100,000 Swiss francs that are not in the business plan can protect you in that case. When we invest in a startup, we have to find a win-win situation between the team and the investors. When it comes to win for the team, it's all about incentives, how much stake in a company you have, how much can you participate in your own success. To determine this, you look at the cap table and you see which founder has what stake in the company. And the very typical pitfall that you could have seen before is a broken cap table. For example, there were 2 original founders, 50-50 each. One founder already left, and the remaining founder has to start with a 50% stake. So I can almost guarantee that at some point this will hit you because you don't have enough equity to incentivize the founder and any other potential founders or employees that need to be incentivized through additional shares that will cause dilution, not only for investors but also for the existing co-founder. Ideally, it's corrected before you invest. We had this situation with exactly one of the original founders leaving before there was the seed round. And we, together with the startup, we found a solution to reset that so that this former co-founder gave back his shares so that the startup had a chance to really start from a good position and to avoid that at some point you have to renegotiate when it might be already too late. It's probably more the norm that teams change. We have to accept it. It's very human. I've experienced this myself. You work with vesting, so either the founders, they agree on day one when everyone is happy that they say, okay, if one of us leaves, the other can buy the shares. So you have a clear agreement that also holds true when you potentially are in conflict. And if you grant equity or options to additional employees, you give that under the condition of a vesting, which means they have to be with the company for 2, 3, 4 or 5 years to get the shares. If they leave before, you can get the shares back and give them to new employees. Startup founders are always very ambitious, otherwise they wouldn't start a business. So all us entrepreneurs, startuppers tend to set very high goals for ourselves, which very often leads to the case that you don't achieve them in the first place. Everything takes a bit longer and costs more. So when it comes to fundraising, I'm very cautious if the current funding round is too small, that the runway is not at least 12 to 18 months, but much rather maybe only 6 months. So now is August, the startup tells me I raised 300,000 and beginning of next year I'm gonna raise 1 million. This is not a good case for me because it implies that from October onwards, the team will just be running after the next big round and will be fundraising instead of working on the business. In this case, we recommend the startup to either raise a bigger round already now or to adjust the business plan in a way that the run rate is not 6 but rather 12 or 18 months. Bridge rounds are very common, mostly convertible notes. They're quickly, you don't need a notary, you can set them up almost immediately. That's something that happens a lot. We also invest through convertibles. The thing is, you can only do it once or twice. If you end up having 2 or 3 convertible notes in parallel, it might become a showstopper for your next round. When you invest in startups, you may have a certain gut feeling during the due diligence. Make sure you speak up or you follow up on this gut feeling. For example, if you have 2 founders and they don't speak to each other, or they keep disagreeing on certain things, and you always have this feeling, maybe they're not fully aligned. Make sure to follow up on that. Because if they go separate routes 5 months later, you will be the one saying, I kind of had a feeling for this. In my experience, if something goes wrong, you usually saw it coming a bit. If a startup constantly pitches you to say we gain 20 new clients a quarter and over 3 quarters they only gain 2 clients, you should already start reacting. You should maybe do a workshop about, is the pitch the right pitch, is the pricing correct, how do they approach what customers, etc. Not that you wait until they already have no money and the team left and it's sort of too late. I truly believe that very often you somehow saw it coming, but very often investors, including myself, reacted too late. So the learning is clearly, when you have this gut feeling, address it. It doesn't have to be in a negative way. Maybe ask for a workshop, ask whether you can help. Ask the founder, do you agree on this point? To hear, maybe they even admit we don't agree, and I can say, why don't you figure it out? And then we find a solution. But make sure you speak up when you see something coming, and really with best intentions to help. Switzerland offers great human capital. There's people with a lot of excellent education. We have world-leading universities. We have corporates where founders have previously worked, where they learned a certain profession. And based on all this knowledge and experience, they can start new companies. And for us, it's exciting, together with the SICTIC community, to invest in these startups, to accompany them, to support them, to help them, in order to promote innovation in Switzerland, to promote Swiss companies and create additional world-leading technologies or companies out of Switzerland that have global potential.